We'll have the first rates come up in just a bit from now. 320 points lower on the Nifty. The sensex is down about 1,150 odd points. So it's everything down. At least at the beginning, is everything down kind of a day, and it's a little over a 1% cut on the Nifty, and about 1.2, 1.3% cut on the Nifty Bank as well. So we'll have the rates come up as far as indices go, and then we'll look at individual names, individual stocks, etc. As well. 1.3 Nifty Bank Nifty. The Sensex is down 1.4. The mid-cap index is down about 1.7%. 23,883, 23,900. So the first support is 23,900 on the downside. And we're opening exactly there with this 300-point knock. 23,263 is the next one, but that's some distance away. I think the Nifty Bank is also at about 51,500, which is around where the I think 51,300 something is the 61.8% retracement of the full rise that we saw recently from the lows to the high. Everything is down, right? I mean, look at that. So you've got 5 names in the green, and 45 out of the 50 stocks which are opening in the red. I think already I'm seeing some recovery. From the lows, I think it's about a 70, 80 odd point bounce, but this is the first minute. And we're down about 1%. So this is in line, as I was saying earlier, in line with Asia, which was not exactly selling off in panic like what we saw last night. It was more orderly, 0.75 to 1% kind of cut across Asian markets. And I think we are opening somewhere there as well. So 250 lower, 23,937. Let's see if some of these levels hold. Rima.
Well, down for the 4th day in a row now for the benchmark indices. Metals is taking the biggest knock today. The metal index is slumped close to about 2%. The dollar index is at a 2-year high at 108. That's weighing on stocks like a Hindalco. Hindalco is now the top Nifty loser, and it's pretty much erased all its year-to-date gains too. So year-to-date, Hindalco is now absolutely flat. IT's been on the back foot through this week. The Nifty IT index is also underperforming the benchmark indices, 2% gone at open for the Nifty IT index. Names like Wipro, Infosys, HCL Tech under pressure. In the banking pack, again, banks too have lost. The Nifty banking index is down nearly 4% this week now, with a 1.5% cut that we're staring at. It's SBI, so PSU is under pressure. ICICI Bank, Axis Bank, Kotak Mahindra Bank, all down over 1%. BEL is weak in trade. On the way up, you've got Dr. Reddy's after the Nomura upgrade. That's a slim gain of about 0.3%. HUL ITC. So the only 3 stocks in the green. One is Dr. Reddy's on that upgrade, and then you've got FMCGs. A little bit of a defensive tilt there.
Well, you know, Rima, the good news is that I don't think the breadth of the market can get worse than what we're seeing right now. Only 170 points that are rising in the first few minutes. That compares with nearly around 2,000 stocks that are declining. So hopefully by the time we wind up in closing bell, we'll be talking about a better breadth for the market. So let's see how that goes. Stocks that are gaining, though, since there are a few of them, IOL Chemicals. That's because they'll be considering a stock split on December 27th. So that's one stock that's done pretty well in today's trading session. And the other one I think is Yatat. You know, that they're going to be raising some money via the QIP route, 700 crores. Issue price at a discount, but for the time being, Yatat has opened up in the green. The Nifty is now moved down to around the 23,900 odd mark. So that's going to be one of the crucial levels that we're looking at. What's under some pressure today? Well, we have a few more stocks that are moving around in trade. Let's just pull up a few of them. You have DOMS that's under pressure. Invero Infra, the stock went to around 370 a few sessions ago, and now that's pulled back close to around 15% from the peak. So keep an eye out on that one. Post its numbers, which didn't look too bad, but it's coming for profit taking. Edelweiss Financial had a 10% move in the last 2 sessions. It's given all of them up. And PG Electroplast, one of those big movers, well, that one as well has come in for profit taking. So it's a down start to trading session. The hope is by the time we are wounding up trade today, that the Nifty will not be down close to 300 points, and the advanced decline ratio will improve from only 162 stocks that are advancing right now. Prashant.
Absolutely. And well, we'll keep our fingers crossed and see how things really pan out. You know, maybe it's everything down. So, I mean, you know, I can go on with more names here, but just assume that everything is down between 3 and 5%. At least stuff which is trading with large volumes is down by that much. And lots of these newer listings, right? I mean, there are so many new listings because the primary market is red hot. Sai Life, by the way, ended 40% higher yesterday. It opened 20% higher. It ended with another 20% gains. Let's just look at Vishal Megamart as well. which ended with a 40% gain. These are all sort of day one pops, 40%, right? And 30% oversubscription, 40% pops. That's been the way of the market recently. It's up 1%, once again, 112 rupees. Came to the market at a market cap of 35,000 crores and add all these gains since then. And of course, MobiKwik is the other one, which listed yesterday, which I think also, of course, went up. I think ended 90% higher on top of the issue price, although they cut the size by 75% of what they intended to earlier. That's another 6.5% up. So, well, some green and on your screens, and these are recent listings which we are kind of referring to. It's easier to count winners on a day like today, so let me do that. So Swiggy is up 0.5%. We highlighted that call, brokerage call is up at about 580. It's done very well, come up from 400 to 600 rupees very quickly. There is Garuda. Garuda, I'm not sure. It's up coming up with a 9% pop. It's got very large volumes, and that's why I'm mentioning this. The stock's at 112 rupees. There's something like a Westlife, which is the McDonald's franchise. It's up 3%, 860 or so. And there's IOL Chemicals, which is up 4% as well. So 421 on IOL Chemicals that's Westlife. And then let's just put up IOL as well. So putting out some green out there, going against the wind, where the wind is blowing southwards. 23,916 is where we are at. Well, let's welcome in, Krishna Sangvi, who's with us. Krishna, great to have you with us here. Thank you very much for your time. And we also have Robert Sokin from Citi, who's now with us on the program. Gentlemen, both of you, thank you for being here on CNBC-TV18. Since it's a sort of global-driven day, so Robert, let me just start with you first. What is your own sense? Markets, of course, panicked a little bit. Seems like the Fed changed the game. September, and we were discussing this earlier, September data was strong, but the Fed cut. Data is strong now, but the Fed sounded much more hawkish. How would you read this? Is this transient? Will the market settle down quickly? Or there will be some turbulence?
Yeah, it's a great set of questions. And I think what we saw from Chair Powell today is a bit more cautiousness on the outlook related to inflation. Some of that is due to stronger inflation that we've seen in some recent prints, but probably more broadly underneath the surface, it's more some anticipation of some potential upside inflation risk that may come from the second Trump administration when it comes into office next year. I mean, the good news in the background of all of this is the U.S. economy continues to be very resilient, grow very robustly. That soft landing looks very much on track. But I think given that they're less concerned about downside risk to the economy, it's natural that they shift a bit to worried about risk to inflation again. And I think as this is digested, for one, the Fed has signaled additional rate cuts next year. But most importantly, they said it's going to depend on the news on the ground and what happens with the data. And so if inflation continues to move down towards target, and if some of Trump's more inflationary policies are not necessarily put into play, I think you could potentially see even more cuts from the Fed next year. But it's very much going to depend on what happens with the data and what happens with the administration in 2025.
Robert, but considering that U.S. equities have had such a strong run, the S&P 500 is on course to end the year with a 25% kind of gain. The positioning, the valuations are sort of stretched. So what is the base case scenario for U.S. equities, given the restrictive monetary policy that perhaps we could see going into 2025 compared to earlier, and the uncertainty surrounding policies? Robert?
Oh, is this for me? Sorry, I thought it was other guests. It's a real challenging environment potentially to navigate the equity landscape. On the one hand, as mentioned, we have a very positive growth backdrop in the U.S. Earnings growth has continued to be very strong throughout the cycle, and our equity strategist base case is that you'll get a significant leg up still from here, somewhere into the mid 6,000 range. So I think, broadly speaking, the backdrop from equities is positive. But I come back to the Trump 2.0 potential risks on the tariff front, in that, tariffs not only tend to have negative effects on the economy, but they tend to be very negative for specific companies, especially sectors that are heavily dependent on China, heavily dependent on certain supply chains. And so you could see some challenges in specific companies and sectors depending on how the tariff landscape evolves. So I'd say, broadly speaking, very constructive overall on equities, but we're watching the tariff risks very closely, both for the economy and for the equity market.
Hi, good morning, Krishna, and thanks a lot, Robert, for staying up for us. Let's come back home then. We spoke about the global landscape. What about the RBI? Out here, domestic people are optimistic that the RBI goes ahead and cuts rates. But now the Fed is indicating that we'll have lower number of rates in comparison to what we were anticipating earlier. What are you factoring in with regard to RBI action here in India?
Sure, I think what you correctly said, global linkage is pretty much relevant on, monetary policy. So to that extent, what happens to India monetary policy, maybe rate cut is partly linked to US. Our sense really is that we'll have rate cuts coming up in CY25. At this juncture, is really difficult to judge whether it's going to be first half or second half, because let's look at it this way. Data points keep on coming. Pretty short frequency. Almost every month you got inflation data point, whether it's India or global. Monetary policy meets, typically once in 2 months in India, maybe 45 days US. So some of these things are slightly, difficult to judge in terms of actual timing. Yeah, directionally, some sort of a rate cut support to economy can come in CY25 should be the base case. Intensity is slightly difficult because that's where, again, the global linkage of rates maybe, comes into hurt the markets.
Okay. All right. Robert, what about you? What are you factoring in with regard to central bank action here in India?
Well, I think the key thing to focus on from our perspective is we are looking for rates to continue to move down. Broadly speaking, in India, emerging markets, developed markets, this is a global central bank rate cutting cycle that we're in the midst of for the global economy, with a few relatively minor exceptions. Bank of Japan, Bank of Brazil are in different cycles. But in terms of the major players in the developed market space, the Fed, the ECB, in rate cutting mode, and India as well. But the key, I think, to focus on is even though the Fed cut rates at their recent meeting and signal a few more rate cuts to come, there's the potential for them to stay higher for longer. Again, coming back down to what happens with the economic backdrop and inflation next year. And if the Fed stays higher for longer, that's going to create challenges for all of these other central banks to ease policy as much as we expect in our base case. So right now we have rate cuts, as I said, broadly coming down across most major jurisdictions. But the extent to which they're going to be able to cut rates depends on their domestic factors, but is also, I think, going to depend on how much they're able and willing to deviate from the Fed. And again, we've seen in the past that the Fed stays high for longer. Other central banks tend to rethink the extent to which they're able to cut rates.
Robert, once again, I want to say thanks for staying up. What time is it there? Midnight?
Almost 11 p.m.
Okay. Well, thank you very much. And, it must have been a very long day, starting with, of course, the Fed and the market and all that has happened and questions from clients. So thank you once again. So just one more thing, Robert, with the slightly global, and this is largely US, right? Elon Musk was an important part of not part of the government, but very, very important constituency now. He said he wants to cut $2 trillion in federal spending. I think the consensus is that he won't be able to. There's not $2 trillion to find. But the people also generally agree that, well, if anyone can do it, he can do it. We've got this standoff on government spending in the US, right? The government shuts down on Friday. Now, that has happened many times in the past over the years, and you always kind of cross that hump. But how do you, as a economist, how do you account for something like this? Mr. Musk is on X saying that, well, anybody who votes for this bill should be voted out. You've got the administration, Trump, and the incoming vice president wanting an increase in spending now and to be debated and passed now, not in March. What does it mean for asset markets in the US? Is there a clear
Yeah.
view?
Absolutely. I think to me, the most important point is that the US fiscal situation is one of very high deficits for the foreseeable future and rising debt to levels that we have not seen since World War II, and then will soon surpass that level in a few years. Right now, it's forecast to be deficits of around 6% of GDP for the foreseeable future per year. And those are very large numbers. And I think what we're seeing with Musk and Ramaswamy, with the DOGE effort, I think on the one hand, that should be applauded. It's always good to try and find efficiency gains where we can. However, I am skeptical that they'll be able to find substantial cost savings, given that the vast majority of government spending is either covered by mandatory spending, so things like Social Security, interest on the debt, and defense-related spending. The non-defense discretionary component of the budget is only about 15%. And so it's not quite clear where you'll be able to find substantial savings. On top of that, some of Trump's policies that he's proposed, such as extending his tax cuts, they're expiring in 2025, are very expensive. I think he'll find ways to pay for most of it. But the bottom line is I think we're going to be in a large deficit world for the foreseeable future. And I'm hopeful that we'll be able to get on a more sustainable trajectory, but I'm skeptical that we'll be able to get deficits down significantly, even with the DOGE and the creative thinkers behind it. So it's a challenging environment. That means probably some additional upward pressure on treasuries than you would have otherwise, given that markets have to absorb all of this debt. So I think that's the world we're in for at least the foreseeable future.
Just on US 10-year yield, you think we'll be north of 5% through 2025, Robert?
You know, our strategy team, our rate strategy team, has around a 4.2% forecast. That was before today's meeting. But I think if the Fed stays higher for longer, you could get a little bit of upward pressure on that. Again, it's going to depend on how the Fed rate cutting environment evolves and how much people are concerned about the long-term fiscal trajectory and other factors under Trump that gets baked into the longer-term yields. But that being said, I would be very surprised if we ended up near the 5% levels. And I think the factors that are in play that are just not in play to really get to those extent. But we are seeing more upward pressure on yields since the Fed's decision. And if we get a lot of inflationary type of policies out of the administration, you could see additional upward pressure from there. So it's something we're watching closely. But I think something in the low fours is much more likely than something close to 5.
Because if it's closer to 5, then that's got an important signaling effect on not just, rates around the world, etc., but equities as well. Krishna, come in there. I was just looking at something like a Vishal Mega, right, which is listed. 35,000 crores on market cap. This morning it's reached 50,000 crores. They did a little north of 600 crores in net profits last year. Say they do 1,000 crores in 2 years' time. It's at 50 times earnings. Now that's a retail business, but just what's your thought on valuations broadly if rates in the US continue to stay? Basically push higher. Robert's saying it's closer to 4 than to 5, but north of 4. But if it's closer to 5, what do you think? What does it do, Krishna, to valuations here, and what kind of businesses?
I think it's the last, decade, especially last 4 years of post-COVID, has clearly laid a nice linkage between the monetary policy, the lower rates, higher liquidity combination to the equity market valuations, which is what has led to some of those, excesses of valuation where we look at macro level, maybe market cap to GDP for a country or for an individual sector or company, those, higher levels vis-a-vis the historical past. And let's look at this way, clearly you need finally some, money to buy stocks. And as long as liquidity keeps on coming in, either by a fresh supply of money or, cheaper cost of money, some sort of, liquidity support to valuations is playing out not only in India, even globally. And that's difficult to call whether it switches at half percentage point change in the US 10-year, or it's a longer number. And let's look at it this way. Exactly 2 years back, we actually had a 5% US 10-year trading. Maybe sometime back it was 375, maybe 360. So those fluctuations on rates on either US or maybe Indian, they do keep on playing out. The challenge really is the monetary policy's ability to influence markets on a shorter end has gone up materially. Even if you step back 4 months back, we had a BOJ event, and the entire market had a nice a negative downplay volatility in a just sharp period of 2 days because something changed in the world. In one central bank decides to change the rates, and so the implications on financial market, I think, on this cross rates, cross monetary policy moves are pretty severe, and that's where some of these volatilities are part of it. Stroke, high valuations are perhaps supported by lower cost of money and easy availability of money combination.
Krishna, once again, markets are giving you that near 10% correction from the top. Would you go out there and buy anything in India right now? And what are the big themes going into 2025?
Yeah, I think markets, again, luckily, we don't have to buy markets. We have to finally buy some companies which are doing well, or some, companies or sectors where incremental change is likely to be better. So to that extent, yes, some of these, corrections in markets does give those opportunity to start, adding stocks. I think on a very big picture basis, perhaps valuation comfort when I integrate. Large cap looks attractive. The only challenge right now is in market is that large cap, while looks valuation was attractive, you got challenge of flows, because FPI flows typically has been negative on, they've been more selling the large caps. So if you look at the flow argument, perhaps, yeah, small and mid caps are still getting money in India as from, flows angle. But yeah, valuation comfort lies in large cap. I think sectorally, it's slightly difficult in the sense that we've seen quite a few divergences across sectors. In same sector, there are a couple of companies doing exceedingly well, some doing reasonably weaker. So that's a little bit challenging to call out sectors, but clearly, stock-specific moves are more likely to dominate at least for next 6 months period is my sense.
Thank you, gentlemen, for joining in. And Robert, once again, thank you for staying up. And Krishna, thank you for joining in. If you don't speak before the year closes, have a good one.
And have a good night's sleep.
Yeah.
And thank you for staying up. I mean, really appreciate it.
Oh, well, he's suited up at 11 p.m., right? That's commitment to work and TV. But let's focus now on the sugar stocks now. Sugar mills are likely to see dual setback, as sources tell CNBC Awaaz that OMCs will prefer cooperative sugar mills for ethanol purchase. And the second one is the increase in ethanol prices could be lower than what was hoped and proposed. To discuss the implications, Atul Chaturvedi, the executive chairman, and Sri Renuka Sugars is now with us on the show now. Mr. Chaturvedi, thank you for joining in. First, let's talk about the pricing bit, because after lifting the restrictions on ethanol production, the industry was optimistic about a hike in ethanol prices. But now sources seem to be suggesting that the price hike could be lower than anticipated. According to you, what was the hike that you have proposed, and what are you hearing? What may actually come?
We've been hearing about ethanol price increase since September, but somehow or the other, it has not seen the light of the day. And now your sources are saying that the increase could be only marginal at around 1.5 rupees or somewhere around that. We were expecting that the difference between maize ethanol, which is currently priced at around 71.86, and cane juice ethanol will be bridged this time around. And we still are hopeful, because we've still not heard the final word on what the new ethanol prices would be. But if it is 1.5 rupees or thereabouts, I'm sure it will be a big disappointment as far as the sugar sector is concerned. Let's face the fact that the FRP of sugar has actually gone up. And this year, the industry is going to be paying much higher for the cane which they will be buying. So there's no reason why cane juice should be priced lower than maize. In fact, we were expecting that this bridge, the difference between the two would be bridged. But your report seems to suggest otherwise. Let's see what is lying in store for us.
Okay, but you've not officially heard anything from the government as of now on the pricing. But assume it comes at 1 to 1.5 rupees. What would be the margins? Will the operations be viable? And what would your profitability look like?
No, in fact, at this point of time, at the current prices, what realization we get from ethanol equivalent to sugar is anything between 36, 36.5. And if it is 1.5 rupees, in fact, you would probably see returns from sugar equivalent would probably go up marginally by about a rupee. So which means it could go up to 37.5 or thereabouts. But the industry will continue to not do well if the increase is only marginal. And there's no reason why maize ethanol should be priced at around 72 and sugar so low. It really beats any logical this thing. It beats me. Yeah.
All right. Hi, Mr. Chaturvedi, and thanks a lot for joining in. Could you help us out with what's the total amount of tendering that's happened from the OMCs? And if you could give us the broad breakup between cooperative mills and private companies. What is it currently?
No, it would be difficult for us to put a number on what the cooperative mills have supplied. But we are also hearing and on your ticker as well that there is some move that the cooperative mills would be given preference over private sector. I see no reason why that should be the case because cooperative mills have also invested and so have the private sector. So I think it should be fair and square for both the sectors, and there's no reason why you should differentiate between cooperative and private. Sugar mill is a sugar mill, whether it's a private or a cooperative one. So let's hope this does not happen because in any case, the private sector has also invested quite a lot in putting up, scaling up the distilleries in the country.
All right. So, Mr. Chaturvedi, the tendering activity has been okay from OMCs is what you're saying, but you can't give us the breakup about what's the mix as of now. Is that correct?
Yeah, as of today, it's difficult to put a number on that because we have not seen this kind of differentiation between cooperative and private till now. Why it is coming down, why it is being talked about now, I really don't know.
Okay, all right. If you could quickly tell us before we let you go, what is your current utilization levels? And what is the volumes you're looking at, say, for this year as well as the next?
In terms of ethanol?
Yes.
If you really look at the ethanol scenario, what the Nifty Aayog had actually suggested was that 55% of the ethanol should be coming from the sugar sector and about 45% from the grain sector. This was the original plan basis which all the expansions have taken place. But now what we are seeing is the positions have turned absolutely upside down. Now, a grain sector is supplying something like about 60% of whatever the OMCs are buying, and sugar sector, which was at the forefront of this campaign, is now doing only about 40%. So in terms of quantity to be supplied by the sugar sector, I think this year we would be supplying or rather diverting about 4 million tons of sugar equivalent towards ethanol. So that would be close to about 4 billion liters as well.
Mr. Chaturvedi, good morning. Prashant here. Just one, to come back to that cooperatives point, you said, well, mill is a mill, right? So there should be no difference. But what could be the motivation? Do you think, if it were to be done, can you think of any reason why it would be done that way?
I really have no reason to believe that the government should be differentiating between cooperative and private. A mill is a mill, and both are servicing the farmers, and both are buying cane from the farmers, and both are actually operating the same scenario. So why should one be differentiated with the other? That actually beats my imagination. I don't see any reason why that should be done.
It doesn't go down that road. Thank you very much, Mr. Chaturvedi, for joining us. It's a pleasure having you here on CNBC-TV18. We'll speak soon again. The market, by the way, I think is recovering a little bit. It's a little volatile, but we're firmly down. But for now, I think it's a big green candle. We've come up and we are trading above where we sort of opened at. We opened at 23,870. We're at about 23,990. And even as we speak, we are coming up a little bit. So I think with a 4% NASDAQ cut, you're able to get away with a 1%, under 1% cut here. I think that will be a pretty good outcome all told. We'll take a quick commercial break here. The primary market is red hot, and we'll have the management of Transrail Lighting join us as their IPO opens today. So all the details you want to know, that's coming up with the top team. Stay with us.
Well, time for some primary market action then. Transrail Writings, the 840 crore IPO opens today for subscription. To talk you through the offering, we have with us the management in the studio. Hi, gentlemen. Thanks a lot for joining in. Well, the first basic question, right? You're raising some money. Could you tell us where is it going to be utilized?
Okay. So we are raising around 839 crores, out of which 400 is primary.
Okay.
And in this, we're looking at 250 crores for our working capital, 90 crores for our capex to expand our 2 tower factories and 1 conductor factory, and 90 crores is for general corporate purpose.
Okay, all right. Just a quick couple of follow-up questions then. With this 250 crores of working capital, how does it ease things for you, in terms of number of days or in terms of working capital requirement, point number 1. And on this 90 crores of capex, what is the typical asset turn that you'll have?
Okay. So for this, what we are looking at working capital, this will be purely used for working capital. So our net debt situation remains the same.
Okay.
And our incremental capex required will improve our factory capacity by 25 to 30%.
Okay.
So that is a brownfield project which we are in an existing factory looking at expansions.
Can you give us, do we have the order book number which you've shared as per the RHP, 10,200 crore? But that's, of course, not, it's a little post-dated, right, till September. What is the latest order book and your L1 position?
Ma'am, the numbers we have is as of 30th June.
Yes.
So it's around 10,100 odd crores, which is the order book, plus there are 3,200 crores of L1.
Okay, but this was as of June.
Yeah.
So as of, say, November end, what would the number look like?
Ma'am, we can't kind of, talk about the future numbers, but we are in a good zone, all I can say.
Good zone would be L1, a pipeline could be quite good. So what are the projects that your L1, if you could quantify that? All in line with the regulations, sir.
Yeah. So L1 is 3,200. 90% of it is T&D,
Okay.
which is a core business, transmission and distribution. And out of that, around 50% is around international, 50% is domestic.
Okay.
So last year you grew pretty well. Your revenues went up by more than 30%. Is this the historical growth rate that the company has enjoyed? I just want to understand that if that's something that can continue, and if you can break up between domestic and exports, the international business, how are both those two segments growing for you? And is there any issue of receivables with either?
Okay. So we've been growing historically in the last 3 years with around 30% CAGR, which is something which we are very proud of. We have a very healthy mix of domestic and international. 60% is international, 40% is domestic. And both our segments are growing. International a bit more and domestic a bit less, but we see that both segments will continue to grow as what we see in the past.
And receivables?
Receivables are very much in control. Our net working capital days is around 75 to 80 days, which is as per the industry standards.
Okay, all right. Give us a few more details. Last year, if I look at it, the total revenues were around 4,100 crores is what you did. Now you have some capex that's coming on stream as well. So in line with regulations, you could tell us what is the revenue potential of the company as of now, post this capex. So 4,000 crores is what you've delivered, but maybe you have a potential of 6,000 crores. That gives us a sense about how you can grow without incurring any more capex. So if you'd give us that number.
So
I think we can safely go up to 8,000 crores of turnover with the increased capex and also the increased working capital, which we are going to have. So safely it will go.
Okay.
So no need to incur any more capex. If the orders come, execution can safely go through. You can compound at a good rate in terms of revenue growth.
Yeah.
Okay. Are you confident about 30% sustaining over the medium term, at least that kind of run rate that you've enjoyed in the past? And also, if you could explain what led to the margin improvement. Now, FY23 margins were 9.5%, FY24 expanded to 11.7%, and in Q1 it's further gone up to 13.3%. So both those two, if you could talk about it.
Okay. So just to explain, we are fully backward integrated, which means that we make towers and conductors, which is around 60% of the requirement of a EPC job. Now, conductors is unique to us. Most of our peers do not manufacture conductors except one who's just started. And this gives us a competitive edge. Also, our international book is very healthy, as I said, 60% where we have a margin profile better than the domestic profile.
How much better is it?
Well, if you see a margin profile at 13%, they would be, notch or two better.
So international versus domestic is around 100, 200 basis points better?
Yeah.
Okay, all right.
Can you continue to expand margins?
I think our guidance is as per last year, around, we did 11.77, first quarter is around 13, so it will be somewhere in between.
Somewhere in between.
So the strategic shift from predominantly domestic to international, where in 2020-21 we were doing only 20% of the revenue from the international market, and actually picking up the jobs internationally has actually helped us to improve our margin.
Correct.
Because almost all the jobs of international are multilateral funded and also having a price variation clauses. So any commodity increase, that has actually taken care. And actually we are very much engineering focused company. As a EPC T&D company, we are focusing on all the three important EPC, means engineering we are very strong. Procurement, we have got 60% of our own product which to used in our project, and construction again is a very much under our control. So we are actually controlling 90% of the cost.
Okay. And the ideal mix going ahead would be 50% each, or do you think, as you mentioned, sir, that you were at 20%, which has now moved higher in terms of international revenue mix? Do you see that ratio even improving further in favor of international, or do you expect it to stabilize around
We
there?
think it's going to be balanced 50-50 because the domestic market also in T&D is growing, and that gives us a very good opportunity to look at project-focused bidding, where we look at the margin profile, and that's our focus. We believe that rather than looking at revenue alone, we look at the complete risk matrix. So how do we improve our margins?
Got it. Okay, all right. Just one more quick question from an industry perspective as well. We hear that at various parts of the globe, there is some supply side issues. Now, you clarify that you all are partly backward integrated, which helps you all in terms of margins. Are there still supply side issues both for your company as well as on, for other competitors as well? Or are most of those supply side issues getting sorted?
Well, from a transmission point of view, we don't see any supply issues, either domestic or international. However, for substations, transformers, there has been a certain amount of supply-demand imbalance, which I am sure that the Indian industry is catching up in terms of capacities, and so would be the international markets. So it's going to get balanced out in the next few months.
Okay, just a quick word. There's an offer for sale of about 440 crore rupees. Promoters are bringing down their holding. By how much? What would the current promoter's stake stand at after the reduction, and why the monetization?
So the promoters today have about 82.5% holding, and after the post IPO, the promoters holding will get reduced to 71%.
Okay, got it. Thank you. Thank you very much, for joining in, and wish you all the very best.
Thank you so much for your time and pleasure being here.
Well, and on the listing, we re-invite you all to join us. And at that point of time, we'll push you all a little bit more for a guidance from here on. But all the best. And we look forward to being in chat with both of you.
Thank you. Thank you.
Well, getting back to the markets, when we're having that chat with the new IPO that opens up, well, take a look at the markets. There's a bit of a recovery that was seen on the headline index because the Nifty went down to around 23,900 odd. From there, we have bounced 60, 70 points. Sustaining this kind of a bounce is going to be important. And also the breadth of the market. I think, Rima, that's something that will help portfolios feel much better. When we started off trade in the first few minutes, there were only 160 stocks that were advancing. That number has gone up to nearly around 600 odd. So the bulls will be feeling a little bit better close to 45 minutes into this trading session.
Okay, let's focus now on the real estate sector. Now, the sector in H1 FY25, which is basically April to the September period, saw fewer launches. Can the launches improve in the second half? And how is the inventory overhang? And what is in store for the realty sector going into 2025? To discuss all this, we have Anuj Puri, Chairman of Anurag Property Consultants, and Rajat Kathuria, CEO at Signature Global India, joining us on the show now. Anuj, just to set the context first, give us the numbers. What were H1 launches like? Why was it lower? Can we expect a pickup in H2? What is the forecast going ahead?
Good morning, Rima, to you and to Nigel. If you were to look at the top 11 listed developers, they had given an indication of about 250 million square feet that they were going to be able to launch this year. By virtue of that, if you were to look at the first half, it should have been about 125 million, but it has been only about 53 million, which is 23% of the guidance that the top 11 listed players had given in terms of the launches. Now, there's several reasons why the launches have got delayed, none of which has been the demand, fortunately, but majority of them has been really the approval and the regulatory delays, largely led by the elections, both at the center and at the state level. Fortunately, the demand continues to remain strong. Many of these listed developers have done QIPs. If you were to look at the real estate index, that continues to remain strong. And not only that, many of the developers have really reduced their debt to equity, which at one stage, if I recall, in 2019 used to be 0.9, now it is 0.5. So clearly, if you were to look at it from a money perspective, there is no problem with the developers. From the demand perspective, that continues to remain very high. I think it is just that they are unable to get in the regulatory approvals and being able to launch. I do feel is that H2 is going to be very strong. And you will be able to see more launches and demand picking up. I'll just say one other thing is because you touched upon this point, Rima, is that the inventory overhang, it is at its lowest ever that we have seen, which is less than 14 months under construction. Usually, it hovers as a neutral between 20 to 22 months. And I do feel is that there has to be more inventory, because if more inventory doesn't come in, the price rise will start to happen. And that's where my fear is that if the price rise happens very quickly, that is where, the affordability index may start to breach. So important that supply comes up in H2.
But do you think by the end of the year, the 11 listed developers will be able to achieve their guidance of 250 million square feet of launches? Question number one. And is there a geographical breakup? Because we hear of tech issues at registration offices, particularly in Bangalore.
It is true, Rima, that the e-Khatha is taking a very long time to be able to, get in the registration of the sold apartments even is. The majority of this supply is going to come in Maharashtra. If you were to speak with these top 11 listed developers, and, Rajat is there from Signature Global, and they are sort of the number 2 guy who had given the guidance in terms of the square foot that they were going to launch. My guess is about 25 million that they had given guidance. I do feel is when you speak with these 11 listed guys, they have a game plan and they should be able to deliver on the guidance that they had given at the start of this year.
Okay, all right, Mr. Puri, got that. So let's get in Rajat then into the discussion. Rajat, the 29 million is on.
So good morning, I think, to everyone, and congratulations to the Analog team for coming up with a very well-researched paper. So, see, our position is that we've upward revised the launch pipeline. So it's actually gone up to about 35 million, of which 9 million has been launched over the last 9 months. We intend to do launches worth 16,000 crores for this financial year, and this was our guidance, and we are very comfortable positioned to achieving it during the course of this year.
Okay, so you'll do more than actually what you earlier thought you were doing, in spite of having a softish start, in comparison, if I look at it mathematically. Got that, Rajat? Mr. Puri, then what do you say? 250 million is what you thought at the start. Only 57 was done at the first half, at the end of the first half. Realistically, what should we end this year with?
My guess is, Nigel, we should be about 225 to 250. Again, I say is that I've met up with these top 11 listed players. Prestige is the number one. Out of the 250, about 75 million square feet is coming from there itself is. They are very confident that they should be able to deliver on the guidance. And it's a delight to hear, Rajat, that he is actually moving ahead of the 29 million square feet guidance that they had given. So I would say is that we should be in the ballpark, to answer your question, Nigel, between sort of 5-10% of the numbers that they had given at the start of the year.
Anuj, in your conversation then with the developers, what are they talking about for 2025 in terms of launches, in terms of execution? You spoke about fundraise. Is it largely done for all these companies, or next year could see more fundraise?
So, Rima, I'm sure that next year we'll see more fundraise. There are a number of developers who are wanting to get into the listed space, so they will be raising more capital. Majority of these listed developers are at a very comfortable position. If you were to look at DLF, Godrej, even Prestige, they are almost at net zero debt. So their ability to go out and buy larger land parcels is very high. On the other hand, demand continues to remain very strong if you go in the mid and luxury and premium levels. And so, they are there's a huge amount of enthusiasm that demand is strong. They are well capitalized and they have the ability to execute. I think the only trouble is how do you get in this approval and regulatory sort of clearances quicker? The rest of it is all sort of well oiled.
Rajat, would you be looking to raise money? I know you did your IPO just last year, about 14 months back, but is there a fundraise on the anvil for you?
So, Rima, there's no fundraise plan as of now. The operating cash flows tend to be supporting the growth of the company. So our operating cash flows are fairly healthy. For this year, we intend to collect close to 6,000 crores, and the budgeted operating surplus is almost 45%, which should give us about 2,500 crores of operating cash post-payment of taxes, which will either go into acquiring new land parcels or will go into debt reduction. And if you look at even the industry, the broader trend is that a lot of the growth is being funded either through equity infusions, because, see, these are listed companies. I think, equity markets have been kind. The balance sheet of all these companies put together are looking much healthier than what they used to look about 3 to 4 years ago. So a lot of the growth is being funded either through operating cash flows or through equity infusions. But for Signature Global, we have no plans as yet to raise any equity in the next year.
Anuj, just one word. I think as of September, real estate companies had raised close to 12,800 crore via QIP. What's the number as we close out the year?
So till September, it was 12,500. I don't have, Rima, what the current number is on the QIPs.
Okay, all right, gentlemen. Thanks a lot, Rajat, as well as Anuj, for joining in. If we don't speak before the end of this calendar year, wishing you all a good end to the year and looking forward to chatting up with both of you all in 2025.
Thank you, Nigel.
Thanks a lot.
Well, let's move on then and let's talk about the markets. There's been a bit of a recovery. The breadth of the market, I think those crisscross lines should come up for you on the screen. It's perked up a little bit, still holding about 500 stocks that are advancing right now. So a little bit better in comparison to 30-40 minutes ago. Mitesh Thakkar is back with us. Mitesh, the temptation is always going to be there, right, to go ahead and buy the first dip. The question is whether or not it will sustain or not, because, the weak hands will get cleaned out otherwise. And today's expiry day, So we're expecting more volatility than normal, like we saw in the previous 2 Thursdays as well. Your take?
No, Nigel, there's no temptation to buy. I think the chart structure is very weak. I talked about the fact that around 23,900 cover your short positions. I think that's worked well. But the structure doesn't warrant any long positions. So, if you booked your short positions, we have some index put spreads. I think, time to take fresh spreads with, maybe around the money strike. You buy 24,000 strike put and sell about 23,700 or 600 strike puts and hold for the next 7 days, which is till the December expiry. My sense is that I think you might get a bounce back if you're lucky enough to about 24,050 odd levels. But beyond that, it looks very difficult in the short term and more likely that, we will possibly test the 200 average area, which is around 23,800. We break that, another 100, 120 points would happen very quickly. So I would be on the negative side. The only place, I had a buy call today morning was Dr. Reddy's, which is pharma. That's doing well. And I have one more pharma stock right now. That's Aurobindo Pharma. I think that's reversing from oversold levels. So buy here with a stop at 1240 for targets of 1310. And on the selling side, I have Kotak Bank. That's a sell with a stop at about 1780 for targets of around 1720, 1750.
Okay, Mitesh, just want to clear that view. As you advised earlier, if you have short calls, you cover it at around 23,900 odd earlier today, which has worked out well. And the fresh strategy you gave us was writing the 23,700 put. Was that correct?
No, buying the 24,000 put and against that selling the 23,700 or 23,600.
Got it. All right. Well, thanks a lot, Mitesh, for joining in and giving us that. We'll keep touching base with you. But for now, Mitesh is, not sounding very, very optimistic about a bounce from these levels. He believes there's more pain in store. For the time being, though, let's focus on the IPO market. The new listing, another one. Well, we have got 4 and 4. Yesterday, 3 blockbuster listings. And this is the 4th one, IKS, listing with a gain of more than 40% as we speak. So those who have got allocated these shares, they'll clearly be quite happy, Rima.
The subscription was more than 50 times for IKS Health. The issue price was 1,329 and the stock has opened at 1869. And this is a company which provides a lot of tech products for, to US physicians, clinics, doctors. So not the large hospitals, but some of the smaller doctors and physicians and clinics. So they provide services which help them manage their revenues. They help them manage the entire revenue cycle, help them in transcribing some of, the documentation to make sure you digitize a lot of the paperwork that doctors need to do. And the company has seen some very strong revenues. I think last year, the company's top line grew to 1,800 crore rupees from just 1,000 crore rupees, and it's backed by Rekha Jhunjhunwala. That's about IKS Health, very strong debut. Get into a break. On the other side, we'll call Manisha Gupta to talk about commodities. Welcome back. Let's turn our attention now to the commodity markets. Manisha is with us. Manisha, hi.
Hi, thank you for that, Reema. Well, I'm looking at overall commodities as a sector because it is absolutely not doing well, especially after the US Fed meeting, where we did see 25 basis point of a rate cut on expected lines, but fewer cuts in 2025 is the sentiment that's weighing onto the space. So with that, you have the dollar index, which is trading at a 2-year highs, and that's weighing onto the markets. So if you look at the crude oil prices, we've seen prices slip by nearly a percentage point, and while it is trading below 73 for Brent, it's trading below 70 for the WTI prices there. And this is even as the US crude stocks have declined by 1 million barrels. That is what is bothering the space. The precious metals were the hardest hit, with the dollar index now at a 2-year highs. We saw the gold prices decline nearly 2.5% overnight. That one is trading at a 1-month lows, and the silver prices were even sharper on the lower side. We saw nearly 4.5% of a decline onto that one. That one is trading at a 5-week lows. The base metal prices also saw sharp declines. The strength in US dollar won, and second, we saw weak manufacturing activity come in from China and US. That was a botheration. And third thing is there's a lack of complete detail on the kind of stimulus measures or fiscal spend that China would do for the calendar year 2025, and that's weighing onto the markets as well. So if you look at the copper prices, it was a sharp cut onto that one, and with that 1.5% of a decline, copper is now trading at a 3-month lows. It's a multi-month lows also coming in for aluminum, zinc, lead. We saw the prices decline to a 1-month lows overnight, and there is still some decline coming in for the Chinese markets there. When you look at the silver especially, it is about weak China demand from industrial metals. It is overproduction of photovoltaic coming in from China, and especially with expectation of US tariffs coming in, the silver demand could perhaps decline in China from industrial sector. That again is putting pressure. For the ferrous metals also, it wasn't such a great night. We saw iron ore prices decline by a percentage point. Steel rebar is now trading at a 1-month lows as well. So even as for the year, many of these metal prices are trading in the positive. But when you look at the week-on-week chart, well, everything is trading in the negative. We have the gold prices down by 3%, silver down 5% on week-on-week basis. Same is the case with the metal prices, where copper is down 4%. 3 to 3.5% of decline coming in for zinc and aluminum, and a couple of percentage point decline for the ferrous metals as well.
Thank you very much for that. For the Nifty, we had gone to levels of 23,000, almost 24,000. But from there, again, we've slipped. So things continue to remain very, very tenuous. News coming in on Tata Consumer. Remember, there were talks about reports about Starbucks perhaps looking to exit its joint venture with the Tatas. They were looking to recalibrate the kind of store openings that they will do in 2025. But, there is clarification now coming in from Tata Consumer. Get into a break. On the other side, it's a special segment. It's the economy. Lata will be in conversation with Mithil Kotecha of Barclays and Neeraj Gambhir of Axis Bank to discuss the impact of Fed's hawkish commentary on emerging markets, currencies and rates.
The Fed's impact is loud and clear in currencies and rate markets too. The rupee has crossed 85 per dollar as expected, and currencies across Asia are down between 15 basis and 75 basis points just today, between 0.5% and 3 percentage points. Only for the month of December, Indian yields have gone up by 10 basis points in December alone, today by about 3-4 basis points, with the US yields jumping beyond 4.5 for the 10-year. The Reserve Bank, this rise in yields in India is happening despite Reserve Bank cutting the CRR and widely expected to cut repo rates as well in its next meeting in February. But how does the Fed change the Reserve Bank's plans? How does it impact currencies, rupee? Mithul Kotecha, head of FX and EM Macro Strategy Asia at Barclays, and Neeraj Gambhir, Group Executive Head Treasury Markets and Wholesale Banking Products at Axis Bank, join us. Mithul, Neeraj, thank you very much indeed for your time for what would be a busy morning at your own trading desks. Mithul, first up, how do we interpret this? I mean, 108 on the dollar index. I read your report of day before yesterday. I'm not quoting it, but you had already written that 107 is not the highest for the dollar index. It's gone to 108. Have we seen the worst, or, you know, can we see the dollar rising even more?
I think the answer to that question is we can see the dollar rising more. Our view is that there is clearly going into next year more upside risk. I know we've had this knee-jerk reaction of the dollar to the Fed. But that said, next year in January, we have a very big event, the inauguration of President-elect Trump, and potentially very significant tariffs placed on China and the rest of the world. And the US economy continues to outperform from a growth perspective. You know, China's economy is still fairly weak. The rest of the world is still flagging in terms of its growth. So all of that seems to show that the US is attracting capital from elsewhere, and that means a dollar upside continues to see momentum here. So while it's not going to be a straight line dollar appreciation, we do, and again, a lot will depend on Trump's policies. We do think the direction of travel is still for a higher US dollar into the first half of next year.
Thanks, Dan. And what about yields, Mithul? This 4.5 was not expected. Many people, of course, expected that the Fed will tone down rate cuts next year. 2 was definitely not. 4 getting reduced to 2 by the FOMC's dot plot was perhaps not in the price. But 4.5 on the 10-year, where do we go from here?
It does feel like the market's gone too far in terms of yields. And really, if you look what's being priced in for a terminal rate now, it looks a little high. It seems, in our view, that even 10-year yields have probably backed up a lot in the current range. And we were looking at a 4.25% range. Look, I think the Fed has moved into line with our view for next year, that we expect 2 cuts next year. And the dot plots now are showing that. But I think there is still room, ultimately, for the interest rates in the US to continue to decline gradually. You know, the labor market is starting to loosen up a little bit now. Inflation, although it has been a bit sticky, is moving lower in the US and to the Fed's target. So there shouldn't be much really in the way of further reduction in rates. So I think this move in interest rates appears to be a little bit more aggressive, and it's a knee-jerk reaction. Our interest rate strategists have actually taken the opposite view. They've gone long 1-year, 2-year US rates, and of the view that market is a little bit too hawkish in terms of what they're pricing.
Okay, I guess the market is also staring at this potential government shutdown, considering the tweets that are coming from Elon Musk and to some extent even from President Trump. And therefore, perhaps worries about the fiscal deficit going overboard. But Neeraj, this makes the Reserve Bank's position a little tough. I mean, let's assume for argument's sake that the 4.5 continues when the RBI meets in February. They will already have had the Jan 20 inauguration. So, you know, does this change the position in terms of the expected rate cut?
So if you look at the Fed policy, I think there are 3 things that the RBI would want to focus on. One is obviously growth. We've had much slower growth as compared to expectations. The second is currency. I think currency is clearly weak, although rupee continues to be one of the strongest currencies on a relative terms as compared to even currencies like Singapore dollar and Indonesian rupiah. So while currency is weak, there is pressure on the currency, but Reserve Bank continues to manage the volatility in the market. And third, obviously, is the overall sort of inflation outlook. We've had stronger than expected inflation in some senses. Food and vegetable price inflation continues to exert upward pressure. And between now and February, we'll need to see how each of these three variables actually play out. We should see some normalization on growth as the government spending has kicked in and as the Reserve Bank has actually induced more liquidity into the system. On inflation front, I think the key driver will be what happens to the food and vegetable prices. So far in December, there hasn't been much respite. So if the inflation print continues to be higher than what the market expects, then that is something which speaks against a potential rate cut in February. And obviously, as the dollar strength continues, the currency pressure will be there. So I think all in all, it is still a possibility that Reserve Bank might cut rates. So February is live in that sense. But I think the pressure on RBI to cut rates in February in some senses actually lessened to some extent as Fed has also backed off from its aggressive sort of rate cutting cycle in the next year. So I think a lot can change between now and February, but I think there is lesser pressure on Reserve Bank now to think of a rate cut at this point in time.
Okay, I'm not done with this line of questioning to you, but let me just get the view on the dollar rupee from Mitul. Mitul, it's taken a while for the rupee to cross 85 because of stiff resistance from the Reserve Bank. Where do you all see it now by year end? That's not too many days, but more importantly, by the fiscal year end, March end.
Right. So, I mean, we continue to see depreciation of the rupee. Our view has been that it's been, as you said, there's been aggressive intervention in recent months, and that's probably artificially stopped the currency from weakening to a more natural level. I agree that the rupee will outperform its peers in Asia, but that doesn't mean that we won't continue to depreciate. So, for example, we're forecasting 87 for dollar INR by end of next year, which, given the pace of the move in the dollar, I mean, obviously that forecast is on track as we currently speak. And I think ultimately there's a few factors here. We believe the rupee is rich on a valuation basis, both on a nominal and an effective exchange rate basis. We think we are focusing again on the yuan as a key factor here. If the yuan depreciates more significantly, which we think it may do, that could also exert downward pressure on the Indian rupee. And that trade deficit with China, of course, is quite important. So you've got that, the slowing in growth, the push for exports and manufacturing, and broadly a stronger dollar. So all of those factors play for a dollar rupee higher. The question is what pace. But we think the RBI will continue to control the pace of depreciation, but not stop it or reverse that depreciation trend.
Okay. No, they wouldn't do that. But they have come in for a lot of covert criticism. It's never overt on the RBI. Covert criticism on being unduly smoothing volatility to the disadvantage of even market participants. But Mitul, just very quickly, do you anticipate that the yuan will go all the way to 8? People have been calling in India for 7.3 like round the corner. It's only now that the yuan has gone to 7.29. Is 8 on your cards? And if yes, when?
Okay, so our forecast is 7.5, again, by end of next year. But we have to highlight the fact that there are risks of a much bigger depreciation of the yuan. Our models show that dollar yuan may even get above 840 if we see 60% tariffs on China and some retaliation. Now, again, this is not our forecast, but the reality is that what it does suggest is that there are still quite significant downside risks to the yuan. Look, if we do see 60% tariffs, it's very likely that we see some mitigating devaluation, depreciation of the Chinese currency. Again, the magnitude will really be dependent on to what extent President Trump inflicts tariffs on China.
Okay. Yeah. And there's widespread analysis that the 60% is only a bargaining tool. And I think Goldman Sachs has some model which says that 20% is perhaps the more realistic number. But 7.31, I believe, on the CNH, on the market rate on the CNY as we speak. Neeraj, two questions actually. First one, now the Reserve Bank has also to tackle imported inflation. If the rupee goes indeed towards, 87 as Mitul says, but, earlier 87 perhaps is year end. Even if it goes to 85.5, there is a fairly serious imported inflation. So will that prey on the Reserve Bank's decision? And what's your own rupee target?
So I think another maybe about 2 to 2.5% depreciation over the next 12 months is quite possible, which is pretty much in line with what Mitul has talked about. Yes, as rupee depreciates, there is a imported inflation or cost push inflation factor that comes into play. But I think that is, in some senses, less relevant in the current context. I think what is more relevant in the current context is how much disinflation do we see in the vegetable and food prices. Because remember, the core inflation in India still continues to be close to 4% or slightly below 4%. So that's not a real worry at this point in time. I think what's giving the inflation its upward trajectory is the fact that food prices and some of the edible oil prices and those kind of prices have actually been on the higher trajectory. Yes, weaker rupee means higher, prices for edible oils, imported edible oils, etc. But I think all in all, it is the overall food complex inflation which will determine the trend of inflation going forward and whether Reserve Bank feels comfortable, with the trajectory of the inflation.
Okay. 2.5 is how much in dollar rupee? You're looking at 85.50?
Basically you can say that whatever is the implied forward rate currently, the forwards are trading at about, 2% or thereabouts. I think so, or slightly higher than that. So I think that's the level of depreciation we should expect. So effectively the forward curve gets realized.
Okay, so effectively probably 86 is very much around the corner, 87 a distance away. Now that is the big message I want to give viewers, that we are looking at a rupee very, very different color. 86 and 87 is freely being forecast both by the forward market and by analysts, and I want to get that message across to everyone. Mitul, Neeraj, I know we have just warmed up. We have to have a more detailed discussion on currencies and rates on a later day. Thank you very much indeed for your time. But do remember, there is also an expected Chinese dumping because they will not be able to enter US markets. Will that impact inflation? There are lots of issues to discuss over here, but that on another day. Wrap up on Bazaar on the note that it's a very tense morning, both for equities and for currencies and fixed income. After a break, Chartbusters will take the action for.